What's up, guys? Welcome back to DCA. So Bitcoin right now is sitting at $38,000. And, this is just quite simply, and I hate to say this is what I've been attempting to prepare you for weeks now, for months even. We've been talking about the fact that when Bitcoin falls below the 20-week moving average, we've been talking about when it goes below the 50-week moving average. Historically, this is what happens. And, the problem is on YouTube, saying these things is typically not popular and people don't like to hear this type of information. So it doesn't gain a lot of traction. Now, that's not to say a lot of people haven't been watching because, I'm truly grateful for all the people that have been around. But, if you've been around, you know that I've been warning this entire time, video after video talking about the evidence is mounting of the fact that we are looking at a situation where the market is going to continue heading down. And I've been discussing the fact that, not only does it appear like the market is going to continue heading down, a lot of the signs that we're seeing are the signs that you classically see in the setting of a bear market. Now, that doesn't mean that we can't turn around from here. But what I want to do in this video specifically is for, anyone that's new that's watching, I want to lay out the evidence for you and just sort of look and see where we're at right now. Okay. So we're going to lay out the evidence that we've been talking about, and we're just going to go over a few of the most basic metrics. And I want to show you why it really looks like Bitcoin and the overall crypto market is in a bad place beyond the fact that we're sitting at $38,000. Everyone knows that. But we're going to lay out deeper levels of evidence to show why what we're seeing right now resembles what we've seen in the past and how that has typically led us into a place where we've been in a protracted down period lasting for a year or more. We aren't traders here on this channel. We're looking at the market from the macro level perspective as an investor. So with that said, if you guys like this type of content, hit like and subscribe. You can head over to the Discord channel to sign up for the DCA Index risk model. This is a model that I've developed which helps you identify when a market cycle may be hitting a peak. It also shows when a cycle is hitting a bottom. Okay, so historically it's identified places where both the market has overheated and is in need of a pullback, as well as times when the market is reaching a bottom. Okay, so the first thing we're going to do is just quickly look, just in general, what is the market doing right now? And what we see is we're sitting down at $38,000. So I actually started this video about an hour and a half ago and had to stop because my dogs had to go outside. So I took them out, came back in and was doing some things and then restarted the video. And we had dropped another, going on $1,000 since I started the video originally. We were at 39,000 when I started this video. Now we're sitting at 38,000. And I kind of want to talk about, what we may see coming in the next days. So this is the volume profile visible range, and it shows you essentially how much volume has been traded at any given level. Okay. And the reason this is helpful is because, you have these areas where the line on this horizontal axis sticks out. These are areas where there have been high levels of volume traded. So, at any given price is what we're looking at. So at 47,000, for instance, there has been a lot of volume. At, if you go into this area where the line doesn't stick out as far, at 44, 43, all the way down to around 41, there has not been a lot of volume traded there. The reason that matters is because in these areas of relatively low volume, think of them as a vacuum, and you will see the price just quickly move between these levels. So for instance, if you look right in this area here, we could guess just by looking at the chart that there's going to be a low volume area there. So if we bring this over, sure enough, you'll see that intersects right into this low volume area. Notice every time a candle comes into this area, it just flies right through. So we never spend more than a day or two in this area. And sure enough, it pans out like that. Okay. And then, on the counter example is if you look at 47,000, we've spent lots of days at 47,000. So those are areas where a lot of support and resistance, depending on which way you're coming to the line from, will form. So, basically what we saw was we had this area right here. So from 45 all the way down to around 40,000. So right through here, we'll make that a different color. We'll make it green. There simply wasn't a lot of volume in those ranges. And we're seeing the same thing. The candle hits that range. You're there for no more than a day or two. All right. In fact, right here and right here were the longest that we were in this range. But one thing you'll notice is, in spite of the fact that we did spend a few days in this area recently, what has been the overriding theme of the market right now? And that is the fact that retail market has sort of vacated cryptocurrency. So there's no, we don't have any FOMO anymore, is the bottom line. And when you don't have FOMO, you don't have the retail market behind you, you have low volume. And low volume, regardless of, what everyone else thinks, whatever the fundamentals behind the asset you're interested in or behind Bitcoin, whatever it may be, low volume is going to lead to prices that are grinding downwards. So we are seeing a position right now where long-term investors are accumulating the asset, but they are accumulating for whenever the next bull market is. That's not to say it can't happen during, sometime in 2022 or even 2023, but the probability is that everything we're seeing indicates that is likely not going to happen. So you have this position where retail has fled the market. There's very low volume being traded, and we're seeing, accordingly, we're seeing the price grind down just like we would expect. So one key thing I want to point out, this was the start of these areas that stick out further are called high volume nodes. All right. These areas that go in where, on the horizontal axis, they don't stick out very far. These are called low volume nodes. When you hit a high volume node, it's harder to grind through that price level. Okay. It's more difficult to grind through a high volume node than it is a low volume node. So that's why we see us fall right through the low volume node down to this $40,600 level. And then the volume starts to pick up. So now we're in the midst of a higher volume node, which, exists basically from 31,000 up to around $40,600. Below that, things get, they get pretty dicey. We don't have another high volume node all the way down until, realistically $23,000. And even that isn't an extraordinarily high volume node. There's a relative vacuum that exists basically from 30,600 all the way down to 23,000. Okay. And then if you go from there even farther down, we'll have to go all the way back. We'll have to go all the way back to 2018 to start to catch any more volume down here in this. Realistically, there's not another high volume node until you get down to $12,000. I don't think that's going to happen. And, just because there's no volume at these levels doesn't mean at some point, if the price of Bitcoin got down to, $30,000, I think you would start to see, some heavier accumulation. But the bottom line is, at least in the shorter term, you're going to, if you get below this $31,000 level, or realistically, down to around 29,000, high 29,000s, if you get below that, I think you're going to see the price, fall and fall quickly. So, looking at something like this, if a lot of people aren't used to it necessarily, people that aren't used to it often don't understand and sort of, dismiss things like this, saying that, technical analysis, whatever. But things like this are backed up by, there's reasoning behind it. The reason is you have a lot of holders at these levels. Holders naturally create areas of resistance because people don't want to sell the asset for lower than they're holding it. So when you have a lot of holders in a range, they don't want to sell you the asset, especially if they're long-term holders. There's no way in hell I'm selling you my Bitcoin for $35,000, for example. And, that's not just me. That's the typical view of a long-term investor. So you have people that, in these levels are holding the asset. So they create a natural sort of a lack of supply at these levels. If you have a lack of supply, then, it's just simple economics. It's going to be harder to drive a price down when there's not much supply. So these you can think of simply as levels of supply, or levels of lack of supply rather, because they're being held by individuals at these levels. So I do think it's going to be, if we do head into this level and we stay here and don't get a bounce up, it's going to be a grind through this $30,000 level. But more importantly, perhaps, what you're going to see is the altcoins. If we continue heading down, you're going to see the altcoins just get absolutely bled to death. And this is something we've talked about a lot on this channel. Altcoins during the setting of downturns, during the setting of market downturns, absolutely get hammered with respect to Bitcoin. And you've been seeing this, basically for weeks now. And, sure, some altcoins have been doing well, but I assure you, even those ones that have been doing well, if this continues and this starts turning into weeks, and then weeks turn into months, and then months start turning into quarters, if we start getting into that type of situation, you're going to be up the creek, so to speak, if you're holding all altcoins. And I just come on and say this every once in a while because I think, it bears repeating, and it's not popular to say. It's not the kind of thing that's going to get me a bunch of subscribers by telling you that you're going to get hammered if you're holding altcoins. But for those of you that are subscribed, I hope the thing that it will do is, just let you know realistically, you need to think about how you're positioned. Now, I hold altcoins and I'll continue to hold altcoins, but I'm not going to be out here, just adding tons of altcoins to, my holdings. Sure, at some point, if the market keeps grinding down and, if I think that we've reached whatever that point is where we're, the upside is going to outweigh the downside, then I might start acquiring. But I'm not going to be adding altcoins to my position while the market is in a massive downtrend. All right. So that's the first thing I wanted to talk about. This is the number of active addresses. So this is just sort of putting the whole thing in perspective. Typically what you see in the setting of a bull market is you have a persistent increase in the number of active addresses. So there will be these contractions, and we've seen them many times. So these contractions happen in the setting of a market cycle. But, what we've seen now is basically a place where we are at the number of active addresses on the Bitcoin network that we were consistently at basically since May of 2020. So we've basically pulled back quite a bit in terms of the number of individuals using the Bitcoin network. All right. And this just speaks to the fact that, the number of people using the network is going to be directly related to the price of the network. And this is kind of what we've been talking about the entire time. When the volume drops off, when the number of users drop off, especially when you're talking about crypto, because of its speculative nature, you're going to see rapid price falls in those times. So right now, and this has been going on since the middle of November, we are seeing the number of active users in a clear and defined downtrend. This is the price volume. The price volume is simply put the price multiplied by the volume. The reason this matters is because times of high interest in the asset, so if we just go back to 2017, because it's more pronounced back then, you can see that basically your price volume ramps up in the setting of the bull market. You have this time when, all right, just the volume is going to exceptionally high levels. And you can see that, basically from where we were in 2018, we are all the way up, 129% higher than we were at our peak back in 2017, 2018. In fact, we're looking on a log scale here. Let's switch that to this. And this just gives you a better appreciation for how many more dollars are being traded on Bitcoin than back in the past. In fact, if you go back to the prior market cycles, they're imperceptible. They don't even make a dent. All right. So this just shows that we have moved into an entirely new paradigm in terms of interest in the asset. So, at the end of the day, we're seeing the volume grind down. And even if volume, let's say, stabilized from here and started going sideways, you're still not going, that's not going to drive prices up likely. You're going to need to see volume increasing before we start going into new higher prices. Until then, you're just going to grind sideways to down. And I truly think that will likely continue. Okay, so, we've talked about, some of the evidence regarding what's happening right now and what it all suggests. But at the end of the day, what are you supposed to do about it? And this is what I want to show you. It's not financial advice. It's simply how I approach the market. And I think it's, if you at least consider what I'm saying and, think about it in ways that you can apply it to yourself, I think it can save you a lot of heartache if things trend the way or continue to trend the way that I believe they're going to. So we're looking at the peak from 2018 or late 2017 to current day, both Cardano and Ethereum. I'm showing you these two assets because of all of the assets from back in 2017, they are one of the only two, or these two are one of the only ones that actually recovered in this market cycle back to their prior all-time highs and higher. And the first thing I want you to notice is this. So we're looking at ADA BTC and ETH BTC. When this trends down, that means that BTC is outperforming ADA or ETH. When it trends up, it means ADA and ETH are outperforming Bitcoin. So there's one obvious trend here. This is in the setting of a bear market or just a general market downturn. So looking at May for both of these assets from their peak to where they got to at their bottom in May, both of them bled 35% against Bitcoin. All right. What about and we won't even go to the wick, we'll only go to the close. What about from the end of January to the bottom of the bear market? ADA was down 92% against Bitcoin. All right. And what about Ethereum? Okay. Ethereum was down at its worst 87% against Bitcoin. That's not even against the US dollar. That's against Bitcoin. So, I've laid it out like this before. A lot of these altcoins that you have right now, I don't care how amazing you think their use cases. Sure, some of them do have amazing use cases, but quite simply put, and this is so important, you don't know what's coming. You don't know what technology is coming out in a year or 2 years. You don't know what political regulation is coming out in a year or 2 years. Now, a lot of people have been talking about uncoupling and, maybe things like DeFi or, metaverse or this and that, they will sort of have their own market cycles. Maybe one day, but I don't think we're there yet. Quite simply put, I don't think we're there yet. At the end of the day, if the bear market starts, they're all going to go down here. Now, I'm not saying they need to go down 90%, but I guarantee you how much ever Bitcoin loses, they are going to lose more. The market and just the general macroeconomic level picture looks terrible right now. If the market continues to trend this way, which essentially all indicators are that it will, we're seeing all of the stereotypical behaviors that occur in the setting of the end of market cycles. So, things like, the price volume, we're looking at that dry up. We're looking at a lack of retail interest. We have on-chain metrics in crypto, which give you a look behind the curtain as to what's actually going on in the market. You don't get that anywhere else. So we have all these tools to use, and to ignore them is foolish. And to ignore what will happen to the altcoins if we head into this situation is even more foolish. So guys, that's it for this one. I'm sorry that I don't have better things to say to you. But, if you followed this channel for any amount of time, that's not what we do here. We look at the market, we look at the data, And, it doesn't mean that I don't want things to go up, because I do. I'm a crypto investor, but I'm going to look at the market from a realistic perspective. I don't have anything to sell you. I don't have a premium list. I don't care if you believe that the market cycles are lengthening. So I, ignore data that I've talked about every single day for 2 years and then start ignoring it when it's inconvenient. I don't have anything like that. So I'm here, simply put, telling you this is what the data shows, and it's not pretty. So that's it for this one, guys. Again, sorry, I wish I had better things to say, but until next time, as usual, see you.